Jen, how are you? Can you hear me?
Yes, I can hear you.
All right, I'm just getting back from the gym, so I'm a little bit casual today. Hopefully, you're having a
The,
hope you had a great weekend.
so it's funny. You came back. I'm going to.
Oh, cool, very cool. Yep, yep. Today's the day, right? Hammer
Yeah,
out those emails or the interviews or whatever you have in the morning, and then go get that workout in. So,
yeah.
yeah. Well, nice to talk to you again. Nice to connect. I was just in Burbank. I had a wonderful weekend. I went to the Kern River for the first time up in like the Bakersfield area.
Uh-huh.
We stayed in Thousand Oaks. I went to Irvine, and then we drove up. I don't know if you've ever been whitewater rafting down that river.
No, I haven't.
It was
I
awesome.
too. Yeah.
Really cool time. Anyways, yeah. So I did think of you. I landed in Burbank, and I was like, okay, maybe next time I'll come see Jen. Right? We'll get that coffee and try to do some deals together. So,
Yeah.
yeah. So thanks for jumping on, and I'm excited to connect and see how we can help our clients. One of the learners clients out. So, any thoughts for what you would like to accomplish, and what thoughts you have so far now that we've had a chance maybe to digest some of the stuff we talked about before, or maybe start with tell me what you're looking for, and then I'll tell you what I'm looking for, and we'll see if it's a fit.
Yeah, I think that would be great. Maybe we share that, the objective to understand how we do it, but also I want to understand your process too. How does it
Mm-hmm.
work?
Mm-hmm.
And the terms and the details, because I
Yes.
have some people that they're asking me. I have one of my guys, he invested in Tesla some
Oh,
time ago, and he
wow.
just make like $1 million in a
Oh,
week. And I'm
yes.
like, I'm so freaking jealous. I told you that I was going to give you money and you didn't took it. I call him another word too, but
Yes.
that's
Yeah.
okay. I'm like, I'm making you money in real estate. You didn't make me money in Tesla. That's
Yes.
fair.
Wow. Okay. And so he's just he doesn't work for Tesla. It's not in a qualified plan. He simply bought some stock and it went
Yeah,
through the roof, obviously. And he's like,
yeah,
I want to sell and get out and maybe go into real estate.
yeah. So he's looking to defer taxes,
Mhm.
and then he knows about 1031 exchange because I brought some experts on it, and I will love to bring you too for that defer. Maybe we should set that up because I have some you know times available for you to come and teach my
Yeah.
class. I
Mhm.
will send you some two dates that I have available in case you
Perfect.
want to join us.
I'd love to. Yeah. Mhm.
Yeah. So what I have is a guy that he invests in real estate, but he on 2011 or 2012 he decides to invest in Tesla,
Mhm.
and he has the stocks that he bought it at 200, and then
Wow.
suddenly last month he decided to put everything that he has in Tesla,
Wow.
skyrocket, did net probably like $900,000.
Wow.
So we're looking at potentially $1 million, and I'm like,
Mhm.
don't touch it yet.
Yes. Whatever you do, don't touch it. Exactly.
Yeah, don't touch it yet.
Rule number one, Jen, you passed the first test. Don't touch it. Yes. Great job.
Yeah. So I told him I need to talk to Brett
Yes.
and chat with him because I know there's a product that might work specifically for what you want,
Mhm.
but I don't know the ins and outs. I don't know the tax rules, but I know that you can defer taxes.
Right.
That's
That's
what
all
I
he's
know.
like, that's all I need to know, right? It's like that's the number one thing on my mind, right? So let's
Yeah.
walk through it, right? So
Okay.
by the way, a couple thousand closes now, 24-year track record, about a dozen or so audits with the IRS, all no change audits. So batting 1,000 when it comes to the legal part. It's always the most important question because people are like,
Yeah.
is this thing legal? Like, how long have you done it for? Like, am I gonna get in trouble? Like, why haven't I heard of it? Well, part of why you haven't heard of it is it's niche. It's a very niche. It's
Yeah.
proprietary. Okay, we own basically there's one tax attorney and one law firm that does all of these. Okay,
Yeah.
and that's the gentleman who started it 24 years ago. He comes from the Arthur Anderson days. If you ever heard of them, Deloitte. Like he was an international tax attorney, mergers and acquisitions person. Started his own private practice, and over the years, he basically developed this. And for the first 10 or so years, it's like they weren't even sure if it would work or it would pass the IRS,
Mhm.
but it did, and it kept working. Okay, and then so fast forward, they kind of rolled it out to like Marcus and Millichap agents. And I
Mhm.
was sitting 10 years ago, and that's when I learned about it. I'm sitting in Sacramento selling multifamily properties, and they tell us about it, and we're like, huh, does this really work? You know, how does it work? You know, and what is it like? And so my story is one where I just slowly started to learn about it, understand the mechanics, and then I rolled it out to all of my clients. And each step of the way, it kept working. It kept working. And then fast forward, they're like, Brett, you know this almost better than anybody. You've been studying under this tax attorney for 10 years, and you know, we'd love for you to be our trustee. It takes a trustee. That's our role as Capital Gains Tax Solutions. We're third party, unrelated to the client, right, who's selling the Tesla stock. And also, we're not the tax attorney. That's important. We're separate. And then there's the financial advisor who's in Dana Point. He manages the assets while they're waiting for real estate, right? So let's just say the deal closes tomorrow. Let's just say $1 million goes into the Deferred Sales Trust. So the first thing we're doing is just deferring the tax. He might have paid $400,000, right? So we always establish that your basis is X, you're selling for Y. You would have paid, you know, 40% or so. Let's just say it's 400 grand, 300 grand, right? So I don't want to do that. I want to defer all that, right? We want you to do that too. So all $1 million goes into the trust. And by the way, you can go to the bank. I was just at the bank on Friday. It's in Irvine. It's called SunWest Bank. It's an entrepreneurial, mostly commercial lending bank.
I was there not long ago. You're going to laugh about that.
Perfect. Okay. So we're in their conference room right next to the president of the bank, owner of the bank. It's like almost like a big private family office. So the first advantage is that's where the bank, it's with the bank who knows it in and out. Okay. They just closed, I think, 16 million last week. Okay. And so you get a chance. So that's be the first step is you and your client, your friend, partner, whatever partner, get into SunWest Bank. Okay. I will fly down and meet with you too, right? And we can all meet, you know, we can start with the Zoom meeting, get with the tax attorney. That's typically the first step. And then if you're like, okay, I think, you know, I like this first date. Now let's talk about getting engaged, right? And then let's, you know, talk about getting married, because you're basically kind of marrying this structure, right? This structure is going to be a long-term structure because you want to keep long-term tax deferral. Although at any point, if you want to pay the tax, you can. But in the meantime, let's talk about the advantages of this. So we sell the asset. We sell the $1 million stock in Tesla. We move it into this trust. It's sitting at SunWest Bank. It's completely protected. It cannot move without the client's signature. Okay. I can't move it, but I'm the trustee over that. I'm kind of like the custodian, or I'm kind of like a 1031 company, right? I'm the third party intermediary, if you will, but it's not my personal account. It's with SunWest. And SunWest has what's called a direct access control agreement, which basically states that it doesn't move without the client's signature. So that's good. He feels good there. He feels good with the bank. He knows it's not moving. Now the next question is where and how to invest it. At that point, this is where we bring Jen in and say, Jen, what kind of real estate syndications do you have, right? And he's like, I like that one. Well, the next day, up to 80%, so let's call it $800,000, can go into Jen's syndication, okay, via an LLC. Okay, so what we do is we actually have the client set up an LLC. It's a brand new LLC. He's the managing member of that LLC, and he's going to do a JV partnership. He's not borrowing from his trust. He's actually partnering with this trust. If you were borrowing, it would be taxable. But since we do this JV partnership, it's not taxable. Okay. And at this point, 80% goes in. The client puts up a $0 down payment. The trust puts up $800,000. Although the client gets 80% ownership of that LLC and 80% of the profits. In exchange for, the trust gets 20% in exchange for an 8% pref.
Who gets 8% pref?
8% preferred return, right? So
yeah, but for you or for?
It's for him. Okay, here's why. Because the trust owes him 100% of that $1 million. So in the very beginning, take one step back, when we set up this promissory note, because this is what your client's doing, he's basically carrying paper in exchange for some kind of collateral plus the return. $1 million plus the return. We typically structure the note as an 8% balloon payment due in 10 years, interest only. Most clients somewhere between 5 and 6% collect on that, but it's entirely up to him. He might say, I'm very wealthy. I don't need or want any income right now. Let's let it roll on top of the trust. Okay. But it's 8% compounding over any 10-year period of time. And he can receive or collect as much as he'd like along the way. But just realize, as he receives either interest payments, he'll pay ordinary income tax, or if he receives the principal, he'll pay capital gains tax in proportion to what he receives.
Following. So what we have here is there's a trustee that is formed where he's the beneficiary.
Pause.
And
Pause. He's not the beneficiary, and here's why. If he were the beneficiary, basically he sold it to himself, and therefore it'd be taxable.
Possible.
He's actually becoming the lender. He's a secured lender, okay? So he's taking
Okay.
the hat off of ownership of Tesla, and he's becoming the lender, and he basically lends $1 million, the sale of the Tesla stock, and we have the ultimate buyer over here who's going to buy it for $1 million, okay? And he's owed that million plus a rate of return, 8%. So he's becoming like the chairman of the bank. So he's actually the lender or the creditor. The beneficiary is the trustee.
Interesting.
But we owe him 100% of the money, right? So we owe him 100% of the million plus the return. And so that's where we say, can we collectively, me, Jen, your client, the financial advisor, can we out earn that $400,000 plus that 8%? You know, I think we can, especially if we have given enough time, right? And so the way to think about it, Jen, is like this. If the government said, Jen, you owe us that $400,000, but guess what? I'll give you a zero interest loan for $400,000. You can invest it in whatever you want, and, you know, as long as it's a business purpose or like commercial real estate. And as long as you do that, you don't owe us that money ever. Zero. I mean, it's 0%. I mean, you don't have any interest on it. When would you pay that back, Jen?
When I'm dead. Me, no, but when he's dead, I guess.
Not even that, because your kids can inherit it, right? And then your kids can step into your shoes and keep going. So that's exactly what this is. It's just an installment sale. He just carried paper, but he cannot be the owner of that. You're either a lender or you're the owner. So some people get tripped up on that and they go, "Oh, I'm giving up all this control, or I'm, the trustee's going to take." No. It's all protected at SunWest Bank, right? It's just like if a bank were to go to Jen and say, "Jen, we'll loan you on that $20 million apartment complex. You're the owner of that, but you owe us that, $13 million, right? And say you put $7 million down."
So you're
right?
playing the same thing as index accounts or variable insurance, but under a trustee. That's how it sounds.
Yeah, that's a good way to put it. That's a good way to put it, right? And you can invest it into stocks, bonds, mutual funds, insurance, ETFs, of course, commercial real estate syndications of your own or with partners. You can do your own business venture. You can do hard money lending with it. So we have a client who's lending it to other people. He can't lend it to himself because that would be taxable. But if you're lending it as a business to someone else, he could even lend it to Jen. If you want to say, you're going to look, however you're structuring it, he can do that up to 80%.
Up to 80%. Does it work like the 1031 exchange where you cannot lend vertical, but yes, horizontal?
So how do you mean? Walk me through that.
Meaning I cannot lend money to my kid, but I can lend money to my uncle.
Yeah, good question. That would be the brain surgeon. That's a tax attorney. That would be like the second call. I haven't had that one asked. Good question. That's a new one. So we'll put that on the checklist over here. I want to say we'll probably. I don't know if you want to say. We'll just wait for that one. I definitely can't lend it to yourself, but that's a good question.
Okay, so he lends the money. There's a preferred return that can be payable to him, and that will be taxable because then he's getting these fees. It's that taxation tax as ordinary income is what you said. Okay, so he's
for the interest payments. Think of it like a 1099. If you took $1 million and stuck it at SunWest Bank and they were paying 8%, then you'd get a 1099 at the end of the year and you just report that to your personal CPA.
I got that. That's your retirement account kind of thing.
Yeah. Now, if you put it into commercial real estate, okay, this is the cool part, right? Remember, you formed this brand new LLC, and you were a lender over here completely, but now you're partnering with the trust. So now you're back to owner again. Check this out. Now you're back to owner, and you're putting in, let's say, $800,000 into Jen's deal. And you go, well, Brett, I'm not returning 8% right away. Well, no, that's okay. You're maybe doing 6 or 7 or 5, whatever. But it's going to accrue, right? It's going to accrue. And then however you guys set that deal up, right? He doesn't have to earn exactly 8 from you or more, but it could be that eventually, right? 5 years down the road when you cash out. He just owes that back to the trust, not you. Like, you're just the sponsor, right? So like, for example, my client Dave, who just sold $7.6 million apartment complex and put $3 million into the trust. He put $2 million with the hard money lender, and that lender's getting 6% on the money. Even though Dave owes back the 8 to the trust, is a little gap there. That's okay, right? We're hopefully going to make that up in the long run. But even if we don't, he just gets a little bit less at the end of 10 years, right?
Okay.
Let's say if it doesn't perform exactly at 8, that's okay. You know, he gets the 6. He's still happy because he made an extra 6 on his scenario was 1.1 million in tax.
Got it.
So don't worry about you're having to return this 8. It's okay. This is also why we keep a 20% little buffer here with stocks, bonds, mutual funds, which are liquid investments, some of the best companies in the world that he's investing in, and the financial advisor will do that part of things. But he has a brand new depreciation schedule with Jen's deal.
Mm-hmm.
Which
Okay.
so you following
I
so far? Am I
think
moving too fast?
no, no, you're fine. I'm just gonna ask you a bunch of questions too.
Sure.
A couple of things. So it looks like 80% he gets to allocate it, 20% gets allocated with the financial advisor. You guys are the trustee, but then he's like the behind everything.
Secured lender. He's the secured lender.
Second
Yeah.
lender. Question for you: who is auditing you and managing all the legal aspects of this situation? I'm guessing that you guys are the fiduciary, and then who handles the performance of SunWest Bank?
Great question. And one little nuance here too. Remember when he puts the 80% into that brand new LLC, he's the manager of that LLC, of which he can now be an owner in your property or can go buy his own. So he's back to the ownership hat. Okay.
Yeah.
He just happens to have this silent partner over here who put up 100% of the down payment, and your client put up 0 down payment, and but he gets 80% ownership. Okay, so think about that, right?
Yeah,
In exchange for 20% of the upside and 8% pref, of which all of those funds must flow back into the trust and then have to pay him that 8. Okay. Okay. So we'll show that on like a graph and walk through that, but that's really beneficial for him because he gets a brand new depreciation schedule. As you know, buying Tesla stock, there's no depreciation in Tesla stock. You're owning a stock, right? Yeah. But as soon as he moves that over to real estate, guess what? Jen's probably going to do a cost segregation study on that $20 million property she's buying. And guess what? 20% of that, is probably going to be offset in the first couple years, right? Which means all of that cash flow that he's getting from that is going to be taxed at what? Probably 0. Okay. Exactly. So this is why this thing is an investment and not an expense. Okay. Okay. So back to your other question. So who's regulating, who's auditing, who's protecting all this? Okay. So first of all, the trust files a tax return. We actually use a CPA firm out of Bakersfield. It's a 55-year-old CPA firm. Okay. And they do the tax return for the trust. Okay, they've done, countless of these over 24 years. So they're providing that. And so the audit risk is very low, first of all. Thousands of closes so far. It's a business trust, and it actually has a very low audit risk. However, it has been audited just over a dozen times, and every single one of those are no change audits, meaning not one single issue within each of those trusts, which is actually truly remarkable if you think about it. If you, Jen, and I were to get audited right now on our business tax return, there might be a receipt or a expense that we shouldn't have put on there or something that's off, and they'll probably have a change. But in all of the deferred sales trust, not one single change, okay? Number one. Number two, well, what happens if you actually get audited? Well, there's a thing called audit defense that the tax attorney provides at no additional charge, okay, for the life of the trust. The largest audit was a $125 million deal in San Diego for the Pinnacle building that sold. Okay. And no change. Now, to the bank standpoint, they're doing compliance. They're doing the regulatory. They're running this thing on their end. They did a lot of due diligence when it came to even having this product offered, okay, before they partnered with us, if that makes sense. So they're providing all of that back in. The trust is charged a $1,500 fee for that per year. That's part of how they get paid, and they provide all of that. So I guess you would say the FDIC, like all of the regulatory bodies that regulate banks are regulating this kind of stuff. And so if they were to get audited by them, and they would show for that, so they're providing that protection, that part of it, right? But they're not necessarily saying we're standing behind the legal part. That's the tax attorney, right? They're just providing the bank service, and they have what's called Direct Access Control Agreement, which basically means, or it's short for DACA. It's kind of like an escrow for the funds. So if Jen does a deal with Chicago Title or Placer Title or Orange Coast Title or whoever, right? You do a deal and you send a down payment to them. The funds don't move without your signature or until you release that to the seller, right? You remove all contingencies and you sign for that. It's the same concept that they're providing here. It's just, think of it like a long-term escrow, right? It's just going on for 10, 15, 20 years, 30 years, however long. So hopefully that answers the bank question. Now the last part is, well, capital gains tax solutions, who's regulating them? Well, trustee services aren't really like regulated per se. There's not like it's a license. At least the government hasn't got their hands in that yet. But really the question is, as a trustee, can like Brett move the money? No, I can't. Every single part of the money moving has to come from the client, the note holder. Okay. I can't take the money to the Bahamas, right? And just, I can't. The bank is going to say, no, we need the signature of the note holder, right? And so you have these protections in place, just as if they were to sell the Tesla stock, pay the tax, walk into SunWest Bank and say, hey, SunWest Bank, can I deposit, $600,000 into your account? They say, yeah, sure. Did the funds move without the signature? No. Now the difference is now we have this trust. Now they need to sign off. Now the trustee, I do need to sign off, right? Because the trustee, remember, is the beneficiary owner of the account. So I do need to sign off on the movement, right? So that you do need that one extra signature. And if that wasn't there, then it would be taxable. But realize I'm a friendly trustee and I want what they want. So I'll pause there because I said a lot.
That's fine. I'm following. So I was trying to understand the concept. So, okay. I think I'm following. I will have a bunch of other questions in regards to the escrow.
Yeah.
It's bad.
Good. It's good questions.
In a good thing, in a good way. Okay.
Yep.
So let's suppose all of this is set up. We verify, check this information. So now he's a manager member, and the 80% that he invested in the syndication. So there's 3 ways of payments for this specific project. I'm just trying to make it practical now. Sure. So for example, I have iLift project, which is an extended stay motel model. There's 3 things that goes. In fact, 1, we offer an 8% preferred return. Second, we offer 70% to the investor, 30% to the management team, which is us. And then at the back end, in a term of 4 years, we pay the principal back plus a 12% return on their money. How is the flow through money? How does this work?
Great question. So the first thing is, whatever your deal has is the same thing. The only difference is you're just paying it to an LLC. Okay. That's the first thing to understand. So like, it's not going to complicate your life. All your client is doing is forming a brand new LLC and happens to have the money coming from a silent partner. To you, it makes no difference if it's the Deferred Sales Trust or if it's his brother Steve, right? It makes no difference. To worry about that. Yeah, it's his LLC. He's the managing member of it. And, he's signing off for the bank, to form that LLC. It goes to that bank account, and then he's signing off to put it in there. Now, my role, I need to make sure that the investment's legit, right? That, hey, you're putting it into and if the IRS were to come, or say, yep, Jen is running a business. It's a commercial real estate syndication. Here are the K-1s. Here are the returns. Here are the operating agreements. Boom. Right. That's all verifiable, right? Okay. But as far as your client's concerned, he's back in ownership again, right? Because he owns that LLC. Okay, so however you pay that back to the LLC is between you and him. Got it. Now the next part is he's got to pay back the trust. Right? So that might be, he might set up the payments. For example, depending on how much income he needs or doesn't need, we want to mirror that. So we typically mirror this 8% over here, and let's say it's a payout of 5%. We want to try to typically mirror that. So let's say you're paying an 8 pref, and then he sends, the 8 goes to there, and then the 8 can flow back into here, and then the 5% pays him. Or he might say, look, I don't need or want any income for 2 or 3 or 4 or 5 years. Then in that sense, just let it compound and let it roll into the trust, let it compound, and it's just building, building, building. And this is called the net income tax advantage, right? Because this may lower his overall taxable income. So the answer is it's flexible, okay? And it depends on his scenario, and it depends on what his income is. And this is where the CPA and tax attorney, we basically design this thing, right? We call it a tax-deferred optimal timing transformational exit plan. It's a big, long thing, but we're going to design this to his specifications. And if something changes along the way, let's change it, okay? And let's adjust that. But between you and him, it's just do your deal like you normally would. And then let's flow through to the LLC. Let's flow it to the DST, and then let's flow it to to him individually. Remember, but it's only 20%. If you had like a 12% year, right? Well, he gets 80% of that 12 after the 8% pref.
Got it.
Pretty sweet, right?
Yeah.
And if you have a huge loss because you did a cost seg, guess what? All of this flow through is going to be offset.
Yeah, I'm
You're gonna
loving
have
that already
to
because that's
blow
something
your
that
mind, right?
I hate self-directed IRAs because I don't use it for buy and hold because it just kills my advantage. That's where the self-directed IRA have a weakness, big weakness. So okay,
Go into that
so
more. I want you to touch on that more. I want to make sure I capture what you said, and I'm recording this too if we want to use this for future training. So walk me through that again, Jen. Why do you hate the self-directed IRA?
because it just make me lose the opportunity to write off the taxes for
Yes.
a buy and hold strategy.
Right.
It's as simple as that. Self-directed IRA is just, you can't use it for buy and hold. You lose all the advantages that a buy and hold strategy will give you.
You got
So
it. Depreciation is the number one reason or top three reasons to own investment real estate or a business, right? And so, and then the second, so you're going to get all of that with the deferred sales trust and you're getting a brand new depreciation schedule. So we're taking his Tesla stock at $1 million. It has no depreciation. We're moving it to the deferred sales trust, of which we can put into an LLC, which we can put into Jen's syndication deal, which we get a brand new depreciation schedule, which can offset all of that income through the DST or through the cash flow that she's producing, right? That's really powerful. And then the next thing is there's no penalty for taking money out, right? So the self-directed, you basically have to keep it until a certain age. I think it's 16 and a half, right, Jen?
65.
Oh, 65. Okay, even worse, right? So that's also part of why I walked away from the self-directed IRA. I was like, oh, this is so cool. But then I'm like, wait, I want to retire like at 45 or 55, like, or 60. Like, I don't want to wait till I'm 65. I might even be around until I'm 65. Like, forget that. Like, I want my time. And this is where we talk the transformational part of this deferred sales trust. It's not just the tax or the depreciation. It's the time it gives you. Like, you can literally get years back because you can retire now by doing this strategy. So you're following me? You're connecting those dots?
I am. Believe me, I'm following every aspect because I don't know if I told you this. I did a little bit of finances when I was in college to pay for my engineering degree. So I got my insurance license and I was getting ready to get my investment license. And then I got, and in fact, I don't know if you know this guy, he's the one that first talked to me about it, about your product. But I'm that kind of person that I talk to my gut too. So I'm very picky on who I want to do business with. And although I don't have anything good or bad to say, but I don't know, something was saying like, you need to figure more out before you jump anything. So
sure, absolutely. And you're doing your due diligence as you should, right? Because when you first hear this, and I did too at Marcus & Mills, I'm like, whoa, this is too good to be true. Like, IRS is going to come get me. Why aren't they telling me about it? But what you'll quickly realize with the deferred sales trust, it's not just like setting up an LLC. Like, it's truly the team of professionals that executes this business plan.
yeah,
It takes a lot, right? And it takes, it took me to even really, I don't know, felt comfortable with it 5 years. But what I've done is I've designed courses and coaching to basically take up the last 10 years of how hard it's been to get to this point, and I make it super easy. And I make it super clear. And I just basically, partner and say, Jen, I'm your go-to person for the deferred sales trust. This is our niche. This is what we do every single day. Now let's figure out how to execute that within your syndication, right? And then help the client, your partner, your friend who's selling $1 million in Tesla stock, right? So that's kind of the full picture to make it easy for you versus having to go out, and get a degree in deferred sales trust.
yeah. No, thank you. Been there, took a lot of classes, not interested. So,
Sure,
okay.
exactly.
So it doesn't make my life complicated. And now I understand from that money, they can lend up to 8%, 20% gets in the fiduciary. Let's talk about that portion and let's talk about the 80% that he's earning. So
Absolutely,
the money comes to him, right? As a owner of the LLC.
Correct.
And his responsibility is to put back, and I have a bunch of questions there, to put back X percentage that was agreed to pay to the trust, deferred trust.
Correct.
As far as he pays that, then he can do whatever he wants with these income of 80%, except the principal, because the principal needs to get back maybe after 10 years, depending how the thing was set up.
Correct.
Okay. So the principal gets back here, he decides, but there's going to be a boundary there depending on how it's structured. Now, the 5% goes back to his account, and then that account, right, needs to be run, needs to be managed. there's 20% that gets there and you guys get some fees because you guys are working hard too. Explain me the structure of these portion. Explain me the 20%. The 80%, I think I got it. It's just flowed through as far as he pays back the agreed percentage with the trustee and send back the principal in the X amount of years that was agreed, then he should be fine handling these monies. If not, I guess if something happened, it's capital gain and taxation for him, right? What happened with that 20%? What happened with the fees and how is that handled? And even what happened with that, let's suppose it's 8% that he has to pay back to his trustee.
Great question. Okay. So let's first establish, the 80-20 part of it, right? So the $1 million goes in, again, 800,000 can go to the LLC, have an investment real estate of his own or with you. However that deal works out, it works out. Okay. Now, when that deal closes out, right? The original amount that was put in, the 800,000 would go back in, plus the 8 pref, plus 20% of whatever his portion of your deal was. That's the first thing, okay? Now, he might have an extra $1 million over here that he made now, right? What does he do with that? Oh, no. Well, he can do he can do a note number 2. So it's one deferred sales trust. We call this the mothership. And he can put another $1 million for note number 2. So now he has the 800,000 plus the 8 pref, right? Plus the 20% upside, plus another $1 million as note number 2. Now they're all kind of combined, and now he has 80% of that total to go to a new deal too. Again, start the new depreciation schedule. In the meantime, you're wondering, well, what happens to the other 20% that's been sitting there? Well, we need to keep that liquid, diversified investment grade securities. It's still owed to him, and it's still earning an interest, okay? So typically, most of our notes earn about 8% net of all recurring fees. Okay, because there are recurring fees with this model, and payout usually around 6 to 6.5 because clients don't want to dip into that principal. Again, back to that concept that most of our clients want to pay the taxes second day to never, so they keep that $1 million in place and they'll just live off the interest as it comes in. They'll try to offset it with the depreciation out here, but they might want to dip in and spend it on a fancy car or travel the world. Great, just dip in there, pay your tax, and go do that. Dip in 100,000, 200,000, or whatever. Let's assume he doesn't want to do that. That other 20% is sitting in stocks, bonds, mutual funds, Netflix, Costco, Apple, some of the biggest companies in the world. We work with some of the best financial advisors in the country. Literally guys from PIMCO, former guys from PIMCO, if you know about them. You can also meet them in Irvine, okay, Newport Beach area. And then second, we work with a group that is very well known. I can send you the recording of it after this call. But in 2008, when the market crashed, the market was down about 37 to 40%. They were down 4.5%. Okay, of the way they hedge and protect. Most of our clients are commercial real estate owners and business owners. They're not stock market people, right? So it has its place, but they don't make their wealth there, right? They preserve wealth there, and they protect and they diversify and they get liquid and they wait, but they're making it on the real estate, okay? But in the meantime, they want to be protected. They want to be hedged. They want to be conservative in their allocation. So that's what we're doing, okay? So this group been around for 23 plus years. That's what they do. They are masters at preserving, still getting some upside, okay, and yet protecting on the downside. Okay, so 2008 down 37.5. They're only down 4.5. The next year they were up 25%. Okay, so that's what we'll show you. But the client has to approve that group to manage their money. That's just one of the groups we use. Now, what happened in COVID-19? Guess what? Market down 35, 40%. At the max, they were down about 9%. Okay, and so what they do is they still have some downside, but they actually hedge and they buy what's called put options to buy these when the market drops. They buy everything at a discount. Okay, and they'll explain that. I'm not the investment advisor. They do that. But now when the market comes back, they're back up again. Okay, so that's what they do, and that's what they're protecting that, and they're keeping in that. But again, how and where the funds are invested, the client has to approve or disapprove of that allocation. Okay, so that's just one opportunity there. They could also put it.
Traders, right? They're traders. If they're putting in and putting out, they're traders. That's what they are.
Sure. They're a financial advising group, and they're one of the best in America at doing it, right? That's what I could say. And we also get discounts on that, by the way, because we have such a big net worth of clients in our membership, right? That all together go like Costco and say, hey, give us a discount. So they've lowered their fee. So if you go to direct to them on the street, you get charged more. But since you work through us, we've negotiated a lower fee. So that's another part of this as well. But yeah, you could say that. I mean, they buy options, right? They buy put options. And so if the market drops, they've already hedged 2 years in advance, and they basically are protected against those losses. And then they immediately take what they made from those losses, Jen, and they buy the stocks at a discount because they think it's like a rubber band. What stretches out, snaps back. And that's what happened in '08. Stretched, dropped, snapped back. But they're protecting the downside, so they're not getting hit all the way to 37%, and they're going to lose 4.5%, and then it snaps back, and they get a lot of that upside. So that's a simple way of putting it, but these guys are really smart. Before the deal closes, you got a chance to interview them, talk with them, talk with the clients, all of the above. Okay, so that's where the 20% is staying. Now, someone might say, well, why can't I keep all 100%? I want to go Jen 100%. Well, I'm sure Jen could do an amazing job, or whoever else, but we don't want too much risk on the structure, okay? So we've never had, in the 24 years, collectively with thousands of closes, not one single financial advisor we've worked with, and we work with thousands, not one single operator, not one single deal has ever failed financially, meaning not meeting the note obligation.
Yeah. Huh? It will be irresponsible for me to take the 100% money too. I won't do that.
Yeah, good point. Exactly. And you don't want that pressure either, right? So again, a lot of our clients won't even put the 80, they'll put the 50. So we kind of cap it at the 80. I'm asking clients in Alabama, it's a $2.6 million deal, and they're taking like 20% to go develop multifamily real estate. They're starting with 80 units, and they have other businesses in real estate they'll be selling, and they want to kind of test drive this thing for the first one. In the meantime, they're protected with the other 80% in like very safe places, especially with COVID-19. So all that being said, we try to be as flexible as we can, but we stay within the guardrails of prudent management. The client fills out a risk tolerance questionnaire. It's a 2-pager before the thing closes, and that becomes the constitution for how and where the funds are invested. So as long as when they come to us and say, well, I'd like to put 80% with Jen. Okay, well, what's Jen developing? Well, she's developing a hotel in South Africa. Or that's out of country. It's a lot of risk. No, she's developing a hotel and apartment complex, in anywhere in the United States. Great, let's do that. She's buying a value add. Amazing, we love that, right? Let's do that. So we're going to help protect the client too, right? And so we're all working as a team. And at the end of the day, tax deferral, liquidity, diversification, new depreciation schedule, and never having to use a 1031 ever again.
Yep, love it. Okay. So now the 20% is managed at, what happened is the 5-8%, whatever preferred return structure, that money goes back to the account. How much percentage goes back to the money growing? I'm assuming that if we have $1,200,000 is sitting in an account, he is paying 8% of the 800,000 that goes back to the account. At the back end, there's some money in, but how much is going out for the recurring fees for all of those details? I just want to see, what's happening with the whole that we are not looking at. And I know the financial advisors will try to grow. Is it growing there in a compound interest? How much is the fees? I just want to see if we have these 20% of the, cup fill up, how much money is going in and how much money is going out to the other side.
Great question. Okay. So remember, it's $1 million that went to the trust initially. And on that size of a deal, first of all, $15,000 to close the transaction is a one-time fee to the tax attorney. Okay. It's 1.5% on the first million and 1.25 on anything above on the gross sales price. Okay. So, but let's just use the $1 million example. So 15,000. So now he's at 985 to start. Okay. Now the note is structured at 985 and it's 8% compounding over 10 years. 8%. So that's what he actually carried back, is that 985 at 10 years. Now that 15,000 is tax deductible, which is nice. Okay. And so now, what are the recurring fees? So the recurring fees are to the trustee and the financial advisor, no matter how and where the funds are invested, whether they're in Jen's deal, whether they're stocks, bonds, mutual funds, doesn't matter how and where they're invested. It's 1.5% per year.
Okay. It's a flat fee, 1.5% of the $1 million?
985. the net into the trust. Okay.
Oh, okay. After he paid
After you pay the whatever
the
fees for the closing
attorneys.
cost,
Okay.
or if it's a real estate deal, you pay your commissions. You paid off your loan. If you had a $5 million deal and you had a $2 million loan, right? Well, you're not gonna get charged on the 5 for us. You're gonna get charged on the 3 into the trust.
Mhm.
Okay.
Yeah.
So at the net present value of that the next year, 1.5%. So if it grows to 3 million, 1.5%. If they take out a bunch of money or it goes down to $500,000, 1.5% on that net asset value, right?
Mhm. Okay, that answered
Okay.
my question. Yeah, I just like
Now,
to say, yeah.
yeah, no, great questions. Let me finish the fees. Okay, there's a $1,500 SunWest bank account fee. That's the DACA, right? There is the tax return, about $1,200 per year.
Mm-hmm.
There's a $250 mark-to-market report, which kind of goes back to your other question about regulation. How are we tracking all this? So 4 times per year for $250, we hired a CPA who's in-house CPA who provides 4 mark-to-market reports, meaning how are you doing versus the market? By the way, funds are held at TD Ameritrade. After they go to SunWest Bank, once they're invested, TD Ameritrade, the largest bank in the world,
Mm-hmm.
right? They just bought Charles Schwab, 24/7 access to view the funds for the client. So there's extra eyes and ears on it. You can log in anytime they want. And then there's a mark-to-market report where they're going to look at the promissory note and what's owed to the client on the compounding 8% on any given quarter versus what the actual asset values are, and they're going to try to mark it up. And so there's visibility on this.
Mm-hmm.
Some years it might earn 15%. Some years it might be down 5%. But over any 10-year period of time, Jen, we're trying to get about that 8% net of all the recurring fees. So remember I said the 1.5%?
Mm-hmm.
Well, hopefully we're going to earn 9.5 to 10, right around there.
Okay.
So net of the fees, it's 8% to them, which is pretty good, again, as long as their tax liability is big enough. But most clients are going to do what, Jen? At the 9 years, 6 months mark, they're going to say, this is pretty good. Let's renew it for another 10 years.
Mm-hmm. And when you do redo it, is there any extra in setting the things up, or what happened after that?
It's like $200 to do like the refinance that the trust pays so the tax attorney for their time to kind of just redo the note or think of it like a refinance of a house. So,
Mm-hmm.
but there's no additional one time for the tax attorney. That was literally one time for the entire trust. Now, of course, if they bring new money in from new deals, right, they'll get charged on that new money coming in from new deals. But on that initial $1 million, it'll just be that recurring, call it maintenance or management fee by the trustee and financial advisor.
Mm-hmm. So after, let's suppose that we hit the 10 years and the person want to still leave the money in the LLC, there's a balloon payment. That's the refinance that you're talking about, the $200. Is that the $200 refinance, or how does that work?
Yeah, exactly. You can just recast the note for another 10 years.
Got it.
So,
Okay.
yeah.
Okay. Yeah. New monies is just new deals. Let's call it that way. New money, extra
Yep.
money.
Hold
Got
on.
it.
Let me mention something too that you want to know, right? Let's say, well, Brett, what if it earns like 12% inside of the trust, right? In excess of this 80/20 over here in the LLC. So part of how this works, Jen, is the trustee, me, the beneficiary, the owner of the trust, I must have the opportunity to make a profit, okay?
Yeah, definitely. Mm-hmm.
So that difference between the fees, let's say it was 10%, the fees were 8, and let's say we earned 11 or 12, well, that 2%, I must be able to make it. So I would take that at 10 years. So we do the refinance, and that 2% would be the trustee, and the rest of it, we would just recast for a new one. So that's what we're doing in that recast as well. I just want to make sure I mention that now, because some people will be like, what? He's making a profit on my money? Well, yeah, if we didn't have that opportunity, this thing wouldn't work. It would be a sham business, and there would be no business purpose, and it would all come crumbling down. So but now that being said, the stock market, most of the time we're right at that 10. Honestly, we're usually right at that 10 with the fees because of the allocations and the professionally money managers. But remember, the outside one, he got 80% of that. So if he makes 30%, that's amazing, right?
Yeah.
He's going to get 80% of that 30. 8 pref goes in. Well, now, Brett, it jumped up to 15. Okay, well, yeah, there's a small part there. There is a chance, there's an opportunity to do what's called buy an option agreement, where they can carve out that excess and carve it out for me, the trustee, okay? And that would be 1.5% on that $800,000 for a 10-year term, or 0.75% for a 5-year term. So we would ask them, hey, Jen, what do you think you're going to do here? Well, Brett, I think it's going to be about a 12% IRR or 15% IRR. Okay, that's pretty reasonable, Mr. Client. 80% of that's pretty good. You know, you may or may not want to buy that option, but it's entirely up to you. But if you tell me, Brett, I think it's like 20, 25, 30%, I think we're going to hit a real home run here. Wow, okay. Well, now, Mr. Client, you're probably going to want to carve out that option, and that's going to give you 98% of the upside, and only 2% goes to the trustee. So you're carving out that. So that's just that's like DST 3.0 kind of thing. But there is opportunity for that. Again, commercially reasonable. We've followed all the guidelines. We've been through the IRS audit, so we know what places are to press and what places to pull back.
Yeah. So it definitely works like that cap for the variable insurance index accounts and everything. So it looks like it's that, but the difference is here you have the opportunity to buy that option. So is your cap 8 or is it 10%?
So so remember, when you form that LLC, you're getting 80% immediately with a 0 down payment. Okay, and 100% of the down payment's coming from the trust. So $800,000 goes into the LLC. They automatically got 80% of the upside minus that 8 pref, right? Now, if they buy that option, let's say for 1.5% on the 800,000, they'll pay that. By the way, it's personal money that pays that. Okay, it can't be from the trust that pays that because you're buying the option for the personal person. Yep. Now, 98% of the upside. So if it earns $1 million after the 8% pref, guess what? $980,000 goes to the person personally, and they put in, guess what? 0 money.
Yeah. No worry. I'm following completely. I was coming more from the cap for you. Like, is your cap after 8% or after 10% that you have? Yeah, that's the cap that I'm talking about. Okay.
So remember, the fees are about 1.5% plus the DACA and the bank account. So 9.5 to 10. Imagine it just stayed 100% in stocks, bonds, mutual funds. 9.5, 10 is what it earned. That means I got 0, right? Because we just had to pay the fees, and we had owed the client the 8. So that's 0 there. So hypothetically, I have no cap, right? Let's say it earned 1,000%, and you didn't buy the option, right? Then you got the first 10, and I got the 909. So. But again, we're not going to be taking that kind of risk. It's possible. But again, over a 10-year period of time, we may be up 500%, but we could be down 300% the next year.
Yeah.
The money managers are probably not going to allow that to happen the way they design things. So honestly, it's kind of a moot point. It really doesn't happen on the stocks, bonds, mutual fund side of things. The real estate side of things, it could potentially, depending on how amazing Jen's going to do for you.
I'm a lucky charm. That's my name. Okay. Well, I think I have a really good grasp about this, Brett, and I would love to set up some time. I know that we're a little bit over time now for you. I don't know. But I would love to show you a couple of dates. I'm going to talk to my friend about what's happening because I told him don't touch the Tesla stock yet because I want to understand this. I know that next step will be to set up a phone call with him to have this conversation and talk about exactly what's going on. He's an artist and an engineer kind of guy, but I know some of these things will be like over him.
Sure. Yeah.
But I will ask him and see your schedule, and then I will schedule some time with you. And, I don't know, moving forward, I want to learn more about this and bring this not only to my program on raising capital, but if you have any other ideas on how we can work together, I would love to hear that.
I'll give you the offer. Here it is. So for $300, you get 60 days of coaching. You get access to all of our online academy. You get access to basically the top secrets of the Deferred Sales Trust, videos that I made, online portal, all of that. Okay, so that's simple. I can send you that right now. You go to capitalgainstaxsolutions.com, scroll down, click on that. That would be the first step. And then number 2 would be you've already been on my podcast, but you get a chance for me to come and do workshops for you, right? Via typically Zoom, online. And you get the ebook that's customized to you for marketing. You get your own CRM that's customized to you. Okay, so that's all part of that package. Number 2 would be if and when we do a deal, there's the strategic alliance referral fee also that's built in. Yeah. It's also nice as well. I'll send you that. I'll send you those details there. But that's simply it. You know what I mean? We want to work with the best in the business. We want to have proven operators like yourself who have a track record for places to place the funds, right? Who that's
Mhm.
what they're doing. That is their specialty. Our specialty is this deferred sales trust, right? And then let's partner. Let's get a chance to grow your business, help those people out. And at the end of the day, there's $17 trillion, Jen, that's going to pass from one generation to the next in the next 20 years. And this is known as the largest wealth transfer in the history of the planet. And they can either pay the government that 30 to 50% in capital gains tax, or they can defer it using the strategy, or trying to use a 1031 or an opportunity zone or different things. But the key is just figuring out what are they trying to do, and then let's bring clarity to that vision, and let's figure out what tool works the best, right? And that's where you bring me on, and I'll coach and educate, and then we set up a strategic alliance, website, so you have that all ready to go. We can track all of this. Yeah, that's it. Let's go. Let's go to help a lot of people out.
Awesome. Yeah, so definitely. I will then show you those dates. I would love to receive that information, even from a personal perspective too, as I'm planning for that too. And then as we move forward, I will chat with my partners to maybe bring this to our savvy investors for the Women Real Estate Network. That's a different entity I formed with my partner for women investing in real estate. We're probably like 7,000 members.
Sweet.
Um, so it's just women, but I know that not everyone will be ready for this topic yet. So it's very specific crew.
Yeah, it's
So
definitely niche.
awesome. Definitely. Well, let me do that then, Brett. And
Okay.
as always, what a pleasure to talk to you. I'm
Yes.
so excited.
Likewise.
And we will just move forward and set up some things together. Definitely.
Sounds good. Thank you so much.